Welcome to my channel. I'm the cover called Guy, and this is my journey to creating a $120,000 per year passive income portfolio. And today I have officially been projected to surpass just over $70,000 a year. All right, so monthly I will be making just about 6 grand a month projected. So today is a new milestone for me. So um, let's go. Time to celebrate. But buying the dip, right? I bought the dip this morning, as you know, November 7th. The market has been down, but it's all right. I got my payout from GPIX and GPIQ. So I bought a dip of Maggie stocks, since that's the one I'm currently building out. All right, so today's video is actually inspired by a comment left in one of my videos to do a deep dive. And if you guys want a deep dive, my opinion, my analysis, my my thoughts behind it, please feel free to leave a comment. I have no issues with doing a deep dives. Perhaps it would change my view or introduce me to a new ETF that I've missed or should have been looking at. All right, before we get started on that video, legal disclaimer. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal or your entire portfolio. Always do your own research and consult a licensed professional before making financial decisions. Again, I am just some random idiot you found online, and I could be completely wrong. With that out the way, let's begin. All right, so this video was inspired by a comment left by at Bitcoin Banking. So I'm gonna go ahead and do the deep dive request on today's ETF, which is XPAY ETF from Roundhill Investment. Right, so it's an S&P 500 Target 20 Managed Distribution ETF. All right, so at Bitcoin Banking, this is my deep dive. These are my analysis. Please again do your own due diligence. I could be completely wrong. I don't know I don't know you, right? So I don't know if where you're at in life. If you're just starting out in your 20s, 30s, or you're in your 60s, 70s. Um, I don't know. So again, you have to mirror what it's being given, do your own fact checking, and see if it mirrors your lifestyle and how you are okay with um, handling the risk of XPay. All right, let's get started. All right, exclusive summary, the core thesis. All right, this in my opinion is not an income fund. Right, XPay is highly engineered tax deferred vehicle, not a traditional income generation fund. Right, it is at the moment a projected 100% return of capital, 20% income, and is a managed distribution policy targeted to be 100% rock, not yield. It is a systematic liquidation of the NAV's fund, of the fund's NAV, right? I personally believe it is structurally unstable, unsustainable. The fund's NAV will erode in any year the S&P total return is less than 20.49%, right? Because the 20% payout plus the 0.49% fee. It is a 100% S&P 500 risk. The fund uses derivatives to replicate 100% of the S&P exposure, providing uncapped upside, but also 100% uncapped downside risk, right? So who is it for? Um, I put this just because in I didn't want to I wanted to be non-biased, but who is this for? It is a niche tool, and it would really be suitable for people that are like maybe like age 60 or 70, right? Where you're like, all right, I don't have much longer to live. I don't mind it eroding the NAV and completely having that um downside, uncapped downside risk. But really, it's only for sophisticated, high tax bracket investors in a taxable account who are explicitly bullish and understand the tax deferred mechanics. Right? It is a high. I believe this ETF is a high risk ETF. All right, deconstructing the 20% income. Where does it come from, right? So the 100% return on capital, that's the payout, that's what they're expecting. And that is, and I got that from the Form 19A notice. Again, Form 19A notice are very, very inaccurate. We will not know until actually the end of the year, but based on this deep dive, I'm just using what is being given out, right? So the Form 19A notice confirms 100% rock target, and that's the smoking gun, right? The 30-day sec yield is minus 0.45%. The fund is structurally designed to generate zero income without destroying the NAV. Right, so sustainability, right? The NAV erosion hurdle, right? 20.49%. The S&P total return needed to break even, right? And I've calculated that by using the sustainability equation. NAV change equal S&P 500 total return, and then minus the 0.49 fee, minus 20% distribution, right? So the S&P 500 long term average return is about 10 to 12%. Therefore, the fund is structurally designed to deplete its NAV over time in a typical market, right? And then you could read the prospective warning, not for investors who do not want the principal to decrease over time. The payout and stability, the cliff risk, right? Year one, the investor, buy the stock at $50. That's your NAV. On December 31st, NAV is $50. Year two, payout is locked at 20% of the $50 from your NAV, your stock price. Investor received $10 a share for the year. Year two, bear market happens, market tanks 25%. NAV falls to 27.26 due to a negative 25.49 total return, plus the 20% payout. Right. Then year three, the payout is reset to 20% of new NAV of the $27.26. The income stream is cut by 45.5% to $5.45 a share. Okay, so this is just a chart, right? So this is giving you an outlook of what your ETF and how it would basically sustain itself in a downturn market, because we have been lucky enough to be in an unstoppable bull market. Maybe not the past few days, as of November 7th, 2025, not the past few days. It has been going down and has been declining. So you can start seeing, okay, if it falls some more, or this is a prolonged bear market, what is happening now, right? Is my ETF going to be able to sustain? What is the strategy behind this ETF, right? Tax implications, the deferral trap, right? So we got to ask ourselves, is XPAY's rock good or bad, right? Well, so by definition, destructive rock, which is bad rock, this occurs when this distribution is higher than earnings. It is a forced liquidation of the fund's own asset, which is the NAV, to make the payment to you, right? It is not a yield. It's just returning your own capital to you as a form of payment. XPay payout is 100% destructive rock by design, unless you have other information that I was not able to find. This is the conclusion that I came with, right? Tax advantage rock, the good rock, right? This is not XPay at all. This type of rock is typically a non-destructive pass-through, often from non-cash expenses like depreciation or certain option strategies classified as rock for tax purposes, right? XPay does not generate this type of rock unless you have other information that you found that I couldn't find. This is the conclusion from my deep dive and what I could find. How rock taxation work, the tax deferral, right? One, you purchase 100 shares at $50 a share. Your total cost basis is $5,000. You receive ROC. You receive $1,000 in distribution, the 20%. Since it's 100% ROC, your tax owed on this is 0 for the year. Basis reduced, your cost basis is reduced by $1,000. Your new adjusted cost basis is now $4,000. So as soon as it hits 0, then you will have tax implications. All right, the deferred tax liability, the trap, right? X-payer holder, you, Bitcoin banking, sells after 4 years. You sell one share at $55. Initial basis is $50. Rock received $40, so $40, so $10 a year times 4. Adjusted basis is $10, right? The $50 initial basis minus the $40 that you've received. Taxable gain $45. So please understand ROC. Versus the SPY holder, right? You sell after 4 years, right? Versus a traditional growth holder, you sell one share at $55. Initial basis is $50. Dividends received, tax annually. Adjusted basis is $50. Taxable gain $5. So this is just an example, illustrative illustration only. Again, this is just for you to understand how this would work. The engine, a synthetic S&P 500 fund. It is not a covered call ETF in a traditional sense, right? XPAY strategy, buy call options, uses deep in the money flex call to synthetically replicate 100% S&P 500 exposure. So you have uncapped upside. Yes, bull market, never ending bull market. Great. Uncapped downside, right? So as soon as it starts to flip and turn negative, you might be in trouble, right? If your goal, right, tax engineered replication. So that if that's your goal, if you're trying to use it for tax purposes, then you have to be on your feet with that. Covered call ETFs like JEPI, XYLD, they sell. These are your more traditional covered call ETFs. They sell call options against its holdings, right? Because XPAY doesn't hold anything. It doesn't actually hold the underlying, right? They have to synthetically create it. So that's another problem in itself, right? So it sell call options against its holding to generate a premium, which is the cash, which is paid out as income, right? So it does have a semi capped upside, and it offers a slightly buffered downside. The goal, income generation. XPay holding. Let's look under the hood. Let's see what's underneath it, right? What the fund actually holds. As of late 2025, the portfolio consists almost entirely of SPY flex call options, right? Deep in the money, 1 cent strike, laddered expirations 2025 or 2026, and then 0.4 of it is actually holding funds, government market, money market funds. My judgment, this is smoking gun for me. The holdings are the ultimate proof of the fund's strategy. All right, the telltale signs: there are 0 shares of SPY or any other dividend paying stock. The option, they are 1-for-1 synthetic replication, not income, right? The cash, this is liquidity to manage payout, which are funded by selling its option assets. So it has to be able to create the synthetic shares to sell it. The why, a purely tax-driven strategy. So why do you own it? To avoid it avoids dividends. If XPay held SPY, it would receive taxable dividends, destroying the 100% rock target, which is why it doesn't. I don't know why they wouldn't want to use that strategy. Again, different preference for different investors. 2, it uses synthetics, right? Use deep in the money calls, which don't receive dividends. It's synthetically replicates SPY exposure. And income starvation, this strategy intentionally creates 0% income, allowing the 20% payout to be forced as 100% rock. Market scenario analysis, total return. In a bull market, great. That's what this fund is for. It has full participation. The fund is designed to capture 100% of the S&P's 500 upside, minus obviously the expense ratio of 0.49. In a bear market, well, you're also going to be participating in the bear market. Full participation. The fund has zero downside protection and will fall 1-for-1 with the market, right? So you're, as much as you are riding it up, you're going to be riding it down. NAV erosion accelerates due to its 20% payout. So yes, you will be paid out, but you are going to be experiencing probably a lesser payout depending on the NAV. Right, so the yield may still be the same, but you're being paid on the yield of that share price. Right, sideways market, worst case scenario, S&P 500 total return equals 0%. The fund's NAV will decline by negative 20.49%. The full payout plus the fee. Now, because this is not a traditional cover call ETFs, and traditionally cover call ETF does best in a sideways market. You don't want a sideways market, meaning the market goes up today, it goes down tomorrow, it goes up today, it goes down tomorrow, or it goes up 1 week, it goes down goes up the next week, or it's basically a kangaroo, right? It just hops. Worst case scenario for you. You buy this and you have it as your holdings, because I wouldn't put it as a core holding. I would not put more than maybe 5% of it. I mean, if market will always go up, yes, you might want to push it. Maybe if you're a higher risk tolerance, maybe a 10% of your portfolio, but I would not put more than 10%, as this ETF, in my opinion, will only perform very well when the market is just booming, right? Non-stop the entire year. The market goes up freaking 1% a day, or whatever percentage a day. Then then you're gonna be raking in the cash. But as soon as that market turns down, you are gonna have your shares cut by 5%, 10%, 15, 20%. And remember, the yield will still stay the same, but you're going to be getting paid the yield based on that current NAV price. And then if the market starts jumping up and down where it doesn't really go anywhere, right? The job market is terrible, high inflation, everybody's getting laid off. That's the sideways market. It's just up and down, up and down, up and down. That won't perform well either. So something to think about. All right, pair comparisons, right? We compared the XPAY Roundhill with JEPI and Global X. These are just some, big cover call ETFs that I picked. I didn't specifically, choose my favorites. I just like JP Morgan because everyone knows who JP Morgan is, and I just use that as an example in almost all my videos because it's just a well-known name and it's just easier for people to understand. Okay. Option strategy, you Bitcoin banker, right? You holding XPay, you buy deep in the money calls. Your upside capture is 100%. Your downside 0. You have no downside protection. Your distribution source is 100% rock. And ideal account is taxable account only, right? And the ideal investor is someone who's very, very active. You have to manually watch XPay, right? Versus someone who holds JEPI, which sells out the money index option. Upside capture, partial, downside protection, yes. So you're getting both best of both worlds. And how you're paid out, it's mix of dividend and premiums, ideal, taxable, or tax advantage. And basically, like Global X sells at the money index calls, its upside capture is capped, downside protection is limited, and again, mixed of dividend and premiums, and ideal account, taxable, or tax advantage. All right, key fund risk, right? So this is pretty much how I came to my conclusion with XPay, right? It's launched in October 2024. Unless I'm wrong, please fact check me on that. That strategy is still new and untested in a stressed or bear or volatile market cycle. So we don't have much data to really go off of an actual bear or prolonged market, right? So liquidity risk, it uses flex options, which are less liquid than standard options because flex options are only available to these big hedge funds, and they sell it to basically other hedge funds or um, other big known brokers, right? This could lead to unfavorable pricing or tracking errors. And then now going to tracking error in a stress market, the fund's synthetic exposure could deviate from the S&P 500. No drawdown safeguard. This fund has zero structural safeguards, no buffer, no hedges. It is fully exposed to 100% of the S&P 500 losses. And then manager risk, the advisor is actively managing rock target and option book. This creates potential for execution error. So you have to believe in the manager and their strategy and how well they perform and execute. Active managing, what the manager actually does. So they try to that they, like I said in previous slide, they maximize rock target, right? Actively evaluates the fund's gain loss position to ensure 100% is return of capital. Source payout, decide how to generate the cash for 20% by selling specific options, tax loss harvesting, or other options. And then they manage the options book, actively manage the ladder of deep in the money flex option calls to maintain one-to-one S&P 500 exposure in the managed roll costs. Final assessment and suitability. So is this for you? Is it not for you? Is it at the end of this video, do you still want to hold it? Do you want to add more? Ideal investor, who is it for, right? Taxable account in a very high tax bracket, 100% bullish on the S&P 500, right? You're all in, willing to accept a 100% down risk, has a sophisticated tax knowledge, and has a clear plan to manage future downturn losses. Who must avoid this, right? Anybody needing stable income, right? I want to know what my payout is going to be in a down market, in an up market, in a sideways market. I want to have a decent calculation of where and how much my payment is going to be. I want to know where is it coming from, how much I'm going to get from it in a high volatile market. How much I'm going to be affected. Is it going to be 1%, 2%, 5% more or less that month, right? Anybody needing capital preservation, right? I care about long-term holding, right? Personally, me, I care about long-term holding, as I want to use my portfolio to be passed down, right? I want to be able to pass my portfolio down to my kids, right? And if you don't have kids, you have to think about, well, what am I going to do with it? Am I just going to sell it? Who am I going to give it to? What am I going to do with it? Or what? Because if you have no principal preservation, you're not going to have anything, right? You're not going to be pass it down if you wanted to pass it down or even donate it. And it's not for anybody who's seeking downside protection, as XPAY has zero downside protection, right? I want to have some buffer. I don't want my portfolio to crash, my ETF to crash, right? Anybody investing in IRA or 401k, and anyone who misunderstands the payout. That's the end of my video. I hope you like it. Subscribe, comment, like, and let me know which deep dive you want to see next. Anybody who leaves a comment, I'm willing to do a deep dive, as it educates me. It helps me explore new ETFs for my portfolio, and maybe perhaps I might end up buying it, making a core holding of mine. Thank you for comment and liking the video, because again, it gives me ideas for the content, so I appreciate that. And I hope this video has helped you.